I love this theme. I'm looking for all the dresses with pockets. So if you've got a startup that uses machine learning to find them and has a recurring revenue business model, come find me. Anyway, all right, well, let's get started. So we're going to talk about Series A investment trends. We'll just jump right in. A little bit of data here, and then I'll talk a bit about what we're seeing over at Mattermark. If you're not familiar with us, we collect data on all the startups in the world. We do this programmatically so that you don't have to. If you've got someone, a virtual worker or a team member who's responsible for building out a lot of spreadsheets, we can save them a lot of time, and they can use us instead to do a lot of that analysis. So let's just jump right in. This is all based on our data or other data that we think is awesome. So you've probably heard that the VC market is in trouble. I don't know about in trouble, but just to give you some context, this is what we're seeing in terms of the funding rounds by deal volume, not dollars, over the past 5 quarters, 6 quarters, I apologize. So this gives you some sense of what's happening there. So that's why people are saying this. If you're a founder and you read these articles, you really should just ignore them. We're going to pretty much say that after every single slide. If you're an investor, you might be curious. So it's really not as bad as we think when we look at Series A. So the last quarter, there were 218 Series A rounds. Think about how many startups are in 500 startups batch this time around, right? This is a lot of deals. This is $2 billion in a single quarter in the US that went into Series A's. And this is what that looks like over history, over time. So yeah, we had a little bit of a down quarter, but what a graph. What a time to be a founder. As a founder, I love it. I started my company in 2012, so I have absolutely benefited from this incredible uptick in Series A volume. So the other graph's kind of depressing. If you look at the short term, it looks like there's like a little maybe downturn, maybe not. But on the whole, there's never been a better time to raise a Series A. So just for the numbers, if you need to write these down, save yourself from doing a bunch of analysis. We're down 17% over Q1. Year over year, we're down 8%. So Q2 last year versus Q2 this year versus H1, first half of this year, down 9%. And down 3% from the 2015 average. So 3%, right? Hardly going to feel that. Where are you going to feel it? If you're a founder raising a round, right? Like, we don't live in stats. We don't have a portfolio. We have one company that we're raising for. And it's still the best time in history to be raising a Series A for your one company. So let's just look at the US versus Europe just to get a sense of what's going on here. So the biggest thing we're noticing is the gap between the US and Europe for Series A's is shrinking. I know we have a lot of international founders in the 500 startups family, and this is a really promising trend for them. Just a little more context for you. So as the US is decelerating, other markets aren't necessarily tracking, and the cost of equity is falling back. So this is most easily viewed in terms of average or median round sizes. And it really comes down to the kind of multiples that founders can command in rounds, right? So this is giving some data. This is according to Dan Fund. So in 2015, in Q3, companies expected a 9.2x ARR multiple. Now, not all startups have annually recurring revenue. Some just have other types of revenue, so this is a blended number. This peaked in 2015, and then it's now back down to 9.6. Now, in context with that other graph we saw, these are still pretty high multiples. So for the founders, you might be able to tell I'm still kind of on the founder's side here. Like, this is a really great time. It's pretty freaking awesome to get 10x revenue on a very small early stage company. So this is context, right? So there's this natural healthy tension between companies trying to raise money and get the best price and investors trying to get a good deal so that they can get a good return. And the reason you should all care about this is not just for the small set of Series A companies that are going to present, but because there are a bunch of seed stage companies where achieving the Series A is the milestone for us as angel investors. So we've been covering the changing value of ARR at Mattermark. We publish a blog daily. We have about 3 posts in this series now. So if you're looking for some analysis around how this is changing, we've been tracking this trend. So things are very sensitive to the public markets, right? So we saw that the markets got shaky back in August, again got shaky in December. Now we're seeing this incredible rebound. Market's basically at the highest point checked my phone, right before I got on stage. Maybe that's not the case today, but ultimately we're seeing a pretty great trend, right? So the value of ARR bounces around very much in connection with the public markets. Again, I would say to founders, just plug your ears. This is just a distraction. This is just noise. You don't need to worry about this. You're just raising money for one company. I'm looking at the door, all the founders over there. But let's just recap. So what's happening? Valuation expectations have gone up. They might have kind of leveled off or dropped a little bit. And we've seen similar declines with companies having fewer deals. So what does this all mean? Well, one interesting thing that's happening is we're seeing fewer seed rounds get done. So this is Q2 2015 versus Q2 2016 seed rounds. And for Series A, this is a big deal because this means the pool of startups that you need to look at is a lot smaller. Now, maybe we get lucky, and all the companies that raised their seed Q2 this year are just better quality. So this is going to take the noise out of the system, and you're going to get a lot of signal. But more likely, the climate scares founders away. So something to be thinking about is you may not have as many opportunities to say no as you did last year. And a lot of the opportunities to say yes you may see in this room later today. So I'm not really a big believer in predicting the future. Thanks, Warren Buffett. And Mattermark has a lot of data. So what I can offer you is anyone who wants to use this data to understand the past, to understand trends, to get data on sectors, that's all available to you. But what we do know about the markets after years and years and years of data is that this is all cyclical. So for the founders in the room, and really for the investors too, I'm a founder and an angel investor as well, it's great to look at data, but that's about the past. And we're building the future, and it only takes one fantastic company to completely change the outcome of your portfolio. I'm really proud to have worked on one such company with Dave. We're going to talk about it in a minute. So I think the big takeaway is we don't really know anything about the future, and it's not like Mattermark's someday going to predict the future, by the way. None of you can predict the future. And you're never going to predict the future. So you should stop trying to predict the future and get super excited about the companies we have today. Thank you.